So where are we going? We're going to give you a little bit of background on partnerships, and then we'll talk about allocations, capital accounts, and what the heck substantial economic effect is. So, what is a partnership? A partnership is an agreement between two or more parties to earn profit. There are a couple types of partners. Two specifically are general partners who actively participate in the business, and limited partners who really only contribute capital, not involved, but they exist. Then we have a partnership agreement, which is important because it's a document that sets forth the rules for the partnership. So it has the rules, legal provisions, like how certain items are going to be allocated among the partners. Partnerships are special in that they're flexible, and what's in the partnership agreement is really up to the partners. They can choose to allocate things to certain people and not other people if they want. And then something to note is partnership liquidation. That is when there is a distribution that ceases or that stops the partnership from existing at all. It kills it, basically.
So now we're going to talk about allocations. So as Allison was saying, the partnership agreement determines how this works. It should all be well documented. So partnerships are pass-through entities. So what that means is any of the income, any of the gain, any of the expenses, they all flow through to the partner's individual returns and has an impact on their personal tax statement. Allocations are what determine the share of income or expenses. And allocations are always set forth in the partnership agreement. So, quick example here. Chris Brown and Connor Blair decide to enter a partnership, CCB, that develops and sells new tax software. The partnership agreement states that they will split everything 50-50. They're both actively participating in the activity, so they're both general partners. So, they will split all the income, all of the gain, all of the depreciation. Another thing that is important in partnerships is capital accounts. A capital account tracks the ownership share of the individual to the partnership. So this is a little confusing right now, but we'll put numbers to it in a second, and it should make more sense. So capital accounts increase when you contribute money, when you contribute property at its fair market value, and when you allocate income or gain to that partner. And they decrease when money gets distributed, fair market value of property gets distributed, and allocations of partnership loss or deduction. And if you think about it, this makes sense. So if you put money in, you are increasing your ownership. If you take money out of the partnership, you're decreasing your ownership, and that is what this is attempting to track. So here we go. Quick example. We're building off our last one. Chris Brown and Connor Blair started their partnership, CCB. They're splitting everything 50-50, and they're both general partners. At the beginning of year one, they both contribute $100 to CCB. They use that money to purchase a computer. They make no money during that year, and the computer depreciates $100. So if we look at our table here, we see that their capital accounts are both increasing by the $100 they contribute, and then it will decrease by the depreciation that they received. Since the depreciation total is $100 and they're splitting everything 50-50, they'll both get $50 each of that depreciation benefit. So now we need to look at substantial economic effect. And this is where it starts to really get confusing. So allocations need to accurately reflect economic interest in the partnership. That's kind of why you track capital accounts. If they don't, then the allocation will be denied. The reason they do this is they want the partner who is receiving the benefit of that allocation to also bear the risk for that allocation. And that's a confusing statement, but we'll get explained with the example. So to do this, we look at 3 different tests. The economic effect test comes first. If you don't pass that, then you look at the alternate test. If you don't pass the alternate test, you look at the third one, the economic effect equivalence. So what is the economic effect test? The benefit must be reflected upon liquidation. So when you track capital accounts, that's kind of what you are doing here, since the allocation is going to reduce your capital account balance. When the partnership liquidates, essentially gets bought out, it will be divided up off of those amounts. Capital accounts cannot go negative. If they do, the transaction will not have substantial economic effect, and the allocations will be disallowed. So we're going to go back to our example here. Pretty much the same. They're splitting everything 50-50, except for depreciation, which Chris is going to receive 80% of that allocation, and Connor is only going to receive 20% of the depreciation allocation. They're both general partners because they're both actively participating. So we're going to look at the example again. At the beginning of year 1, they're both contributing $100. They use that money to purchase a computer. They make no money during the year, and the computer depreciates $100. So we have year 1 in that top table to the right. We have their contribution, which increases the capital accounts, depreciation, which is going to decrease the capital accounts. And then we get our end of year 1 capital accounts. So Chris is going to have 20% ownership afterwards, and Connor is going to have 80% ownership afterwards. At the end of year 2, they still haven't made any money, but the computer depreciates another $40. So if we look over to the right again at that second table, we're going to see that this transaction, this allocation of depreciation, is going to make Chris's capital account negative. So this does not have economic effect and will not be allowed. And because of that, the depreciation must be split between the 2 of them. The distribution fails the test because there is no corresponding economic burden to Chris for taking more depreciation. So since it must be split between them, so the depreciation must be split between them instead, which is what we see in this top table here. So instead of Chris getting $32 for the depreciation and Connor getting $8, they're both going to have to split it 20-20, and this will keep Chris's capital account above that 0 balance. So there are things that you can put into the partnership agreement that will continue to allow this to happen, essentially, without having to split the allocation like we see in that top table. A deficit restoration obligation requires general partners to make up their capital account deficits. So if your capital account goes below 0, you are required to add more money into the partnership, which we see here on this very bottom table. Chris will have to add $12 more of contribution to get that capital account balance to 0. So now we're going to look at the alternate test. The alternate test is unique because it's used for limited partners. Now, if we remember back from the beginning, limited partners do not need to contribute more capital. That's one of the benefits of being a limited partner, is you can't take on any more unintended risk. So, like we saw before, they had something that you can put in the partnership agreement to allow the transaction to work, the allocation to work. We have one for this situation as well, which is called a qualified income offset. So we're going to go back to our example with CCB. They're splitting everything 50-50. Depreciation is split 80-20 to Chris. Connor is a general partner, and Chris does not participate in business activities at all. So he's a limited partner. So we go back to our great example here. As we see on the right, Oh, and